Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. I am Josh Lee and I'm here with Billy Norman, who's one of the other financial advisors in the business. Billy, how's the week going and how's things on your end, mate?
Yes, going great. Thanks, Josh. I actually live right near Kingston Heath Golf Course. The Australian Open is on at the moment. And what happens is there's like parking chaos around here because everyone's going to the event. So for compensation, they slip in some free tickets into your letterbox.
You're kidding?
So I'm going to wander down there with the kids and the wife a little bit later and check it out.
So it'll be a good night down there. How long do you typically stay around there for?
Well, with a 3-year-old and a 6-year-old, it's up to them really. It might not last long. It's not the most exciting thing for little kids to do, so we'll see.
Fair call. Well, that's kind of my life at the moment. Obviously, baby Leon now is 3 weeks as of yesterday, and my wife actually left me alone with him for a couple of hours today, and I was a bit scared. I won't lie, but got him to sleep, and he's been sleeping for the last couple of hours. So all good on my end.
Living the dream.
Living the dream. But we're going to do today's podcast a little bit differently. And just to kick off, Billy, I asked you to, we're thinking of having a whiskey on the podcast. So I think you've gone out and bought something. What have you got before we kick off and get into some of the questions we're going to be answering?
Yeah, I've got this one here, a nice single malt. It's called Tomerton.
Tomerton? I haven't
it's
had
a
that.
bourbon and sherry cask aged whiskey. So yeah, that's how we go.
Yeah, how's that going to go?
Yeah, beautiful. I don't normally kick off at 4 p.m. on a Friday into the whiskies, but
what I've done is I had to raid the cupboard, and the best I could find. So I don't have the actual bottle here with me, but I've just given a bit of a dash of Coke and got the old Gentleman Jack. You can't go wrong with a little bit of Gentleman Jack. So it's always refreshing. That always refreshing. But yeah, to your point, I don't usually get started at 4 o'clock on the Friday. Still got a bit of work to do. So, but let's move into it. So this podcast, we're going to be doing a bit of a Q&A of some questions that have come through, and we'll just bounce back and forth here. So the first question I might throw your way, Billy. So I'm new to investing and keep coming across terms like hedged versus unhedged, active versus index, and ETF managed funds versus buying individual shares. There's obviously a bit to unpack in a few different parts to that question, but can you start by breaking down what some of those terms actually mean to the average investor?
Yeah, sure. So hedging relates to currency. So if you think about it, we're in Australia. If you invest in the Australian share market, it's simple, right? Using Australian dollars, you're investing locally. If you want to invest in the American share market with Aussie dollars, you're going to have an impact there in terms of currency. Like whenever the Aussie dollar moves versus the US dollar, that's going to affect the value of your investment.
Yeah.
So what some investors like to do is remove the currency risk, and they do that via hedging. So if you invest in a hedge fund that's investing overseas, it means that currency movements won't impact the value of your investment. And there's some strategy there, like sometimes you will choose to be hedged or unhedged or a mix of the two, depending on your view on currencies.
Yeah, and it's an interesting one. I tend not to get into the weeds with clients around it unless they want to and they're a bit more technical with some of their investments. But how do we generally approach that? And like historically, the US dollar, Australian dollar, like are we typically going more unhedged or hedged with investments?
Yeah, so I think if you zoom out on Aussie dollar versus US dollar, it all comes out in the wash. Like there isn't like a long-term trend where the US dollar's rising or the Aussie dollar's rising. So over a really long time frame, you can probably just be unhedged, and that's fine.
Yeah.
And hedging costs money too, by the way. When you hedge, there's a small price to that. So what you'll typically do is you might go 50% hedged, 50% unhedged, and then depending on your view of currency at that particular time, you might adjust that to try and squeeze out a bit of stronger performance based on currency movements. But I'm sure you'll agree, like predicting currency in a short time frame is nearly impossible. So we don't tend to go too hard, like take a really strong view where you go, we're going to hedge everything or we're going to go fully unhedged. You tend to have a combination of the two.
Yeah, part of that kind of gets into a bit of speculation. Even the experts and economists out there that try to put their reputation online talking about this stuff generally never get it right longer term. But it's obviously something that we do address in our internal investment committee with the investments that we're selecting and recommending to our clients. But what if we move on to active index? That's a big debate that's been on for a long time.
Yeah, so active. So this is one of the key things you need to consider when you're investing. Um, Index investing means essentially you're taking all the research and analysis out of it. So if you're investing in an index fund in the Australian share market, for example, an index fund will simply buy the 200 biggest companies. So they'll buy shares in the 200 biggest companies on the market. It's all automated. There's no like research or analysts or stock picking or anything like that. You're just buying them all. And that means the fees are really low. The other option is an active fund, which means you do have, you've got analysts sitting there going, okay, BHP shares are better value than Rio Tinto shares, like they're picking stocks. Now that comes at a price. There's more fees when you go down that path. And what history is showing is that index funds typically do better. But of course, you still, there's lots of different indexes. Like there's the Aussie market, which we just spoke about, but there's the there's share markets all around the world. There's different types of assets, so that you still need active investing in terms of like which indexes you are going to use.
Yeah, and
what's your view? How do you think about that?
Yeah, well, I was going to say, like, if we use a couple of examples that we've actually done with our clients in the last couple of years, you've seen through COVID when interest rates hit their bottom, and there was a lot of, typically retirees will hold a lot of traditional bond funds that were just, an index bond fund, and that's, historically giving you a steady passive income. And then we went through the fastest rate of interest rate rises that we've ever seen historically, and we as at the investment committee level, like, we collectively agreed to get out of some of those passive index bond funds and went into some active bond funds, and that turned out to be a great move and decision, because through those interest rates going up, we knew the effect that it was actually going to have on those index bond funds. And we won't get too technical with it on this podcast, of course, but some of those bond funds, like, they had negative returns of over 10 to 15% plus, which was huge. But we were able to pivot out into some active funds that actually had positive returns or even neutral returns over that same period of time, which is better than a negative 10 to 15%. So there's definitely no perfect solution, I don't think. But if you want, do nothing, never really have to think about your investments, well, index is generally going to be the way to go. Like, it's just passive, low maintenance, low cost, don't need to make a call on anything. But we have clients that obviously want to be like that, but we also have clients that want to do a little bit more, and then we have a portfolio exactly for that. But it's probably good to make note that we don't go, we aren't fully active with our investment approach. So the most of it, for most clients that want some of that active management in the portfolios, we might have maybe 40 to 50% of their portfolio in active funds, and then have a big chunk of it still in index funds to keep it low cost, but also ensure that there's going to be a bit of market tracking in that. But we've seen over the last couple of years, some of those active funds have done absolutely amazing and outperforming, their benchmark. Like, some of the international share funds we had in there, outperformed by 15, 20% over, 12, 18 month, 24-month period of time. So it's there's definitely some good to be had there, but you do need to be a bit more careful. And as the disclaimer always is, past performance never an indicator of future performance. So you never want to just look at the fund's performance and go, yeah, that looks like a great fund, I'm going there, because you've probably seen it before, Billy. Historically, it doesn't usually happen like that every single year.
No, like the best outcome is a combination of the two. But I think what we usually tell clients is, like, if you're just starting out investing and you're not starting with a huge amount of money, you can't go wrong just buying some low cost index funds and adding to it each month.
Yeah.
But as soon as you get a decent sized portfolio there, you definitely will get a better outcome having some like degree of active management, where you're deciding which indexes to use, or potentially using active funds in the mix as well.
Yeah. And what about then, like, buying individual shares and stock picking? Where does that come into the mix of what we're talking about now? Because we've talked about active funds, index funds, which is kind of the ETF and managed fund space. But where does individual shares come into the mix? And, how do we generally approach that with clients? I know I'm not a stock picker, so.
Yeah, that's it. I mean, like buying shares directly used to be far more common, but these days there's like thousands of different funds, right? There's index funds that track an index, there's active funds where you're paying a fund manager to decide which stocks to buy. So it's really at the point where you don't need to be picking individual stocks. Like there's so many affordable options in the managed fund world, you can just use funds for that purpose. It's sort of fun, like it's fun picking stocks, and people like to think they're going to make a good choice. But over the long run, it's very rare that you're going to get a better outcome picking individual stocks versus if you just feed money into a bunch of managed funds.
Yeah, I think I was chatting about on the last podcast with Steve around stock picking. Like generally, everyone starts their investment journey like that, and I was actually no different. And realistically, really, you're just gambling at that point in time when you know nothing and you're not doing all the research and you don't understand how to, read a business's balance sheet and profit and loss and understand all the headwinds around the world and how they may have an effect, like something happening in China, how that could affect a company back in Australia and tariffs and things like that. Like if you're actually not across all of that, you're virtually gambling. So,
Well,
you are
you're
having a bit of a fun.
competing with fund managers, so you're competing with Goldman Sachs and JP Morgan and Macquarie, and and the chances that you as one person are going to beat the big guys there are just pretty low. Like maybe in the like small company space, like really speculative stocks, like small mining companies, you might get lucky and find one that takes off. But generally, over the long run, it's rare to get a better outcome than just using those managed funds and then focusing your time and energy on like your career, right, and earning money, which you can use to invest. That's how I
Exactly.
think about it anyway.
No, that's a great point. What have you got for me, Billy? If you want to throw one back my way.
What have I got for you? Well, here's one I keep hearing recently. Share markets are near record highs, right? And we had the US election result. Markets have moved higher again. Yet it feels like in the real economy we're in some sort of recession, right?
Mm.
So if I've got some cash to invest, should I be putting that in the share market? Like markets seem really hot. Am I better off just waiting until there's a crash or like a pullback and then investing? What do you think about that?
Yeah, like how often do we get that question? Like at least once a week, I'd say.
Yeah,
And
yeah,
like
probably.
there's
Yeah.
obviously a lot of determinants as to the true answer to what a client should do, but how I would generally approach that is probably on the size of the money that we're talking as well. Like, are we talking $1,000 or are we talking $100,000 or $500,000? If it was a larger sum of money, I would be more concerned around pushing it in one go and then just really hoping that you get in a good time and the market keeps on going. Like, yeah, the markets have been running hot. There's no one knows when it's gonna pull back. Naturally, markets will pull back, and that's healthy for that to occur. But for it to crash, I believe that's defined of the market's dropping over 20%, and I don't think we've seen that since COVID. So I know there's been a lot of volatility over that period of time, but there's no way of trying to pick the right spot to get into the market. Like it's impossible to get it. And the people that I've seen try do that typically will buy at the wrong time. They always get it the opposite way. They buy at the wrong time and then they sell low. So they buy high, sell low, which is not a good thing. So most clients I work with, generally my approach is dollar cost averaging. I do that for
Mm.
myself as well. Even if I've got a large sum of money that I want to deploy into the markets, unless the markets have already taken a crash, and I can talk to personal experience. When the markets crashed during COVID, I did heavily invest at that point in time, and I took advantage of that. But mind you, the markets were plummeting like at a rate we really haven't seen before, and I was buying, and I'm like, I don't know if this thing's at the bottom yet, and I was buying because I thought, look, it's not going to stay like this forever, but nobody knew. That's the biggest thing. Nobody knew. So most clients, dollar cost averaging. So what does that mean? If we've got $100,000 of money to invest, rather than we push that into the market in one go, we might take that $100,000, divide that over the next 12 months and invest steadily every month over the 12-month period of time to average the price in, and therefore take away the risk of and that volatility in the market of pushing the money in, and then you're kind of hoping every night that like the market just keeps on growing. Some clients might be okay with that, but the mass majority of people I see don't want to sort of do that approach for larger amounts of money, and it's also not necessarily required. But it's quite interesting, Billy. We did that. We did a 12-week challenge on dollar
Oh
cost
yeah.
averaging versus lump sum investing on TikTok I think that was a year or so ago, and obviously that
Yes.
comes a bit down to the timing. And at 12 weeks that we did was not a long period of time to actually prove which is better. But that's part of what we were looking at doing. Like, what's better if you just put the money in one go, or you dollar cost average in? Do you want to maybe talk to that and how that panned out and why?
Yeah, so we had, when we posted that stuff on TikTok, we had people in the comments section telling us which option was better. And the data shows you're more often than not, you're better off investing in one go. That's simply because over the long run, markets rise. Like, they rise more often than they fall on a particular day or in a particular month. But when markets are at record highs, that does change the equation a bit.
Yes.
There's also the sort of money psychology side of things too. Like, if you inherit $1 million and you whack it all into the share market, and year one the share market falls 20%, you're going to be losing sleep, or wondering if you made the right decision.
Yes.
Whereas if you feed it in every month over, say, a year or two, you're going to get comfortable with what you're investing in. And if the market rises, you'll be fine. You'll still be in the black. If there is a pullback, well, you get to, okay, that's fine. I've still got plenty of cash here. I'll buy in now at lower prices. So
got some powder. Yeah.
That's it.
Yeah. No, good. I like that. And what if we move to another one? Biggest misconception people have about financial advisors and the value they provide. What are your thoughts? And we get that question said in a lot of different ways. A lot of the time. What's your response there?
Yeah, well, financial advisors aren't all the same, right? It's like a lot of professionals. Like, if you see a lawyer, right, they specialize in different things.
Yep.
Accountants, a lot of accountants will just do your simple tax return and not too much else. But then you'll have accountants that are dealing with family trusts and companies and business owners. So there's not all financial advisors are the same. That's the first thing. The second thing is, financial advice has evolved quite dramatically in Australia over the last 10, 15 years. If you go back 20 years, a financial advisor might typically be placing your money into a super fund, purchasing life insurances for you, and generally not a whole lot more than that.
Yeah.
Whereas these days, we've worked really hard to give people what they want, which is, let me understand more about you. I want to understand your life, your history, a bit about your family, your career, and more importantly, what do you want that you don't have? What do you want in the future? And it might be something simple, like, I want a really nice retirement. I don't want to have to lose sleep about money, something like that. I want a bigger family home. So we want to get a deep understanding of that, then apply the strategies, right? So we're not just taking money and investing it. We're trying to actually improve your life and help you get the things that you want in your life.
Yeah.
And the investment choice and the tax strategies, that's like secondary.
Yeah.
So I think that's a misconception. One is that we do a lot more than what people think.
Yes.
But also, every advisor is different. Some might still just be dealing in that, placing money into markets, and that's it.
Yeah, I think.
What's your view there?
Yeah, no, massive. I think you hit it perfectly there. It's like I always say to a lot of clients up front when they book through to chat with me, all of the things that you're probably expecting I'm going to do, like, how to invest your money, how to better improve your cash flow and how to save tax. Like, they're all the things that we do. Like, there's a lot of different basic advice areas that we will always focus on. But like you said, it's about going deeper than that, because saying your goal is to buy an investment property, that's not actually a goal, it's a strategy. But it's, what is that going to get you though? How's that going to make you feel? What sort of life is that going to have you living? And that's what ultimately we're trying to determine. And I think also sometimes I think the lines get a little bit blurred between advisors and accountants. Like, historically, people I think have gone to their accountants for financial advice. And I still see that, not so much anymore, but I still see that. And I think a part of that was just through our industry and all the ups and downs it's had, and the Royal Commission that we had in 2019, and it was just really battered. We had say 29,000 advisors a few years back, and now we're at about 14,000 advisors Australia wide. So I think the sort of name and profession financial advisor hasn't properly been recognized, but I feel like that is changing now, and people are starting to realize what a true financial advisor does. Don't get me wrong, like in any industry, there are always still going to be bad apples out there, like, getting my car fixed by the mechanic. Like, there's still going to be people out there that do the wrong thing, but that doesn't paint a picture of the whole industry. And I think people are starting to now realize the integral and important role that the advisor plays in their life. And I tell the clients, like, my role is to basically project manage your life in a way, and I will then be the sort of connector between your accountant, your mortgage broker, a lawyer if required, or a buyer's agent, because ultimately none of those people are going to provide you, or shouldn't be providing you, financial advice, I should say. Some of them will still give you their opinion and sometimes cross the line a little bit, but they're not the ones, making the vision and making the advice and the plan. They've got a very, very important role, but it's actually the advisor's role to do all of those things and then get all of the team aligned so it then ultimately suits your goals and where you're trying to go in life. So I think every client I speak to that sees and understands then truly what we do and the value we provide, I think they love it. I've never, haven't had a bad problem from doing that and that sort of approach before.
Well, I actually had someone call in yesterday, inquiring about getting an advisor, and they said they were calling like 6 different advisors, and they wanted to compare everyone. And I said, can I just give you some tips here? Please don't shop around on price, because this is your life, this is your future, your money. It's not something to just go find the cheapest if you're going to get an advisor.
Yeah.
And the other thing I said is that it's a personality thing too. Like, whoever you choose to be your advisor, you're going to you want to like them. Like, you want to believe they're on your side and you have some level of trust and they've got your best interests at heart. You don't want to be sitting there in meetings with someone and you just don't like what they're saying or you don't like their approach. So it's actually just a personal thing, a personal choice as well. Probably add to that.
Always going to be cheaper. There's always going to be more expensive as well. But like you said, that shopping around and just trying to find the cheapest is not always good. And I would say for what your financial advice is, you going cheap and cheaping out on your life and your future, I don't know, wouldn't recommend it.
Agreed. Yeah. So on that, Josh, do financial advisors only work with wealthy people, or is it possible for everyday people to benefit from having an advisor?
Yeah, good one. Yeah, I've had this question quite a bit, and I would say there's probably no one out there that I couldn't probably help in some capacity. But then it gets down to, well, is that worthy of actually having a financial advisor? I guess some businesses will target high net worth clients. So that's probably where this question comes a lot from. Like, people think, historically you only have a financial advisor if you're worth millions and millions of dollars and you got millions of dollars to invest. But like, some of my, if I just talk to my own, some of my great clients are, in their early 30s, really just getting started in their wealth journey, may or may not have their first home, earning, good okay money, but they're nowhere near their peak earnings potential. And I can, make an amazing financial plan for them. I guess to try and answer that question, if I said who are clients we probably don't work so much with, someone that comes out of high school, finishes high school, they're maybe in uni or they're just starting part-time work. They could benefit from getting some financial advice, but for the cost of actually getting advice as well, it probably wouldn't be worthy of doing. And when clients come through to me that are probably not at the stage to get traditional and full financial advice and have the ability to pay the fees for it, they just need general education at that point in time. And I'm more than happy to say, look, these are books that I've read. These are resources to go look at. These are the things that you can do, and then come back in the future years and then get some advice. So I don't have too many clients that are probably in their 20s. I think I've got 2 or 3 that I work with on an ongoing basis, but they're kind of outliers and doing really well and really succeeding. So, those younger clients generally not so much. And then also, even if it's an older couple, if I paint a picture of someone not having much assets, so they're renting, they've got minimal in super, they've got minimal cash savings, they're earning, minimal wages, there's probably not a great deal of financial advice I can help with at that point in time. Yes, there's some advice I could probably provide them, but is that going to be worthy of them paying a fee? I wouldn't allow it to happen. So, getting financial advice certainly not just for the wealthy. Most of my clients I would not deem as wealthy. I would say that they're going to be wealthy in 10, 15 years time after working with me though. But a lot of my clients I wouldn't deem as being, wealthy and high in net worth. The mass majority of them I would say is in that, like, average Australian couple earning decent money, trying to build for the future. So certainly not for the
Yeah, so
wealthy
you
in my
made a
view.
good point in there. You said I wouldn't work with them. So it's actually down to the fact, like, if you're in a position where you think, I feel like I need to speak to an advisor,
Mhm.
you can speak to an advisor and we can have a chat, and
Yep.
then we can help you determine, should you come and pay us for financial advice, or do you need something else at this point in time?
Totally, because a great advisor, they're going to tell you up front. They're not going to waste your time, and they're not going to try and put you through a process, or they shouldn't, and charge you fees. Like, they're going to be very transparent and upfront and just tell you when it's not right for you. And sometimes we have to do that. And sometimes people come through to me thinking they need an advisor, but really they just need an accountant as well. So,
Yeah, or they
I'm
just need a decent mortgage broker to help them figure out the loan for that first property or something like that. Yeah.
no, exactly right. Is there anything else you would add to that, or I'll throw another question your way?
No, I mean, yeah, like, is it only for wealthy people? Again, all advisors are different. So some
Yes.
advisors, yes, they only deal with wealthy people, but there's
Yep.
plenty that don't. So
Yep. Totally. Which one will I go? So, how do I balance saving for big goals like buying a house or retiring whilst still enjoying my money now? So that's the old 101, want to have it all and have that great future as well, but live the best life at the same time. How do you balance that one with clients, Billy?
yeah, so we call it trade-offs. I
Yeah,
think, Josh, like,
true.
you've only got so much resources, right? You've got so
Yes.
much time, so much income and assets and so on. So we go through a process to answer that question.
Yep.
First, it's gathering information, so understanding, what do you have, what assets do you have, how much do you earn, and then it's, what are your goals, what are you wanting to achieve? Do you want some sort of retirement? What's the time frame? You want to buy a house? We also like to do lots of travel. And then we look at how, what resources do we have? Can we achieve all of those things? Or are we going to have to say, okay, if we want to go overseas twice a year, then buying a house might not happen as quickly as you want it to. And then once we've figured that out, then it's just laying out a plan to tick those things off. So it's generally going to be some sort of cash flow structure. Right, so you earn this much. These are your essential costs. We've got a separate bucket over here that's saving for holidays. We've got another account here where we're going to save up a house deposit,
Yep.
and then just checking in on that every 6 months or so until we achieve those things.
Yep.
And if you want it all, well, then it might be back on you to go and figure out how to earn a bit more money or something. Do some extra hours, or get a pay rise or something like that.
Yeah. No, very true. I think that's a great way to sum it up, and I don't think I'll even add any more to that, because life's just full of trade-offs, and you've got to pick your poison in a way, don't you? You've got to choose what you want, and if you want that lifestyle, you have to be willing to put the work in for it. So there's always a way, but it comes down to you, which is sometimes where you battle the most, which is with your own mind. I think a lot of people.
That's it, and that's part of our job too, being like a third party that sits there and goes, okay, you've said you want these 4 different things.
Yes.
And trying to figure out what's actually important, and is there one of those things that actually doesn't really matter.
Yeah. No, very, very much so. Before we close out, I've got a question I've prepared for you, Billy, that I've wrote down here. So, what was your biggest learning from being a financial advisor during the GFC? Because I wasn't an advisor during the GFC, so I can't answer this one. So, what have you got there for me, Billy, and the listeners before we close out?
What was the lesson in the GFC?
Yeah.
That's a tough question, Josh.
Or was there a big learning, or for what you seen clients do, and then that made you evolve as an advisor? Like, you looked at things a little bit different, and understood things differently from going through that?
Yeah, I mean, a simple one is that, like, when you're investing, you have to have a long time frame for investment.
Yeah.
But what I saw is, there might have been people who thought, well, it's, share markets rise and fall. if it falls a bit, that's fine. I'm in for the long term. When it actually happens that dramatically, your mindset can change very quickly. And people see their portfolios dropping 30%, 40%, and now they think, I can't take it anymore. So you might think you have a good tolerance for risk and you're comfortable investing and so on, but when a big event like that happens, it can rattle you.
Yeah.
And that's obviously a big part of our job as advisors to make sure that you stay the course and stick to the plan through those periods. The other thing I learned is it's about life in general. It's unpredictable.
Yep.
So there might be a period of time for a few years where nothing sort of changes in your life. Everything's fine. You're going to work. The kids are fine. Like you're not really have any major worries. And then something can just come out of nowhere and change everything. And that can happen in markets and in the economy as well.
Yeah. No, I think that's
so when we're giving advice and building these plans, we just have to have in the back of our mind one of these events will happen again, but the plan has factored in that could happen.
Yeah, for sure.
We know what we're gonna do.
And if I look back at the last crash we had during COVID, that was the first one I experienced from being in the industry. And fortunately, I only had one client who I couldn't stop from selling their investments during that time. And, we call it like talking them off the cliff, like they're there at the cliff and they're ready to jump and sell everything and get out. Unfortunately, all of my clients listened to me, bar one. And then unfortunately, that person still hasn't really forgiven themselves for it because they actually sold at the bottom of the market, which I think was February, March, or somewhere around there in 2020, and then did the typical thing of, well, now I want to get back into the market, and the market just moved so rapidly during that time. It like bottomed very rapidly, and then just shot up so quick, and then of course they ended up buying back in near the top. So we as advisors can only help to a point, but we can't stop people, unfortunately, still making sometimes stupid decisions with their money. But I think that's one of the biggest values you get from working with an advisor is an objective opinion. And a good advisor, basically, I just tell clients, part of my role is to help you avoid making bad decisions. As simply as that. I know it's part of my role.
That's it. And you probably raised a good point there. In those periods like the GFC, there was actually incredible opportunities too.
Yeah.
It's different. It depends on your situation. Like if you're retired and you're just trying to preserve your wealth, then you're really just trying to ride it out. But if you're in a fortunate position where you're working hard, you're generating a bit of extra cash flow, there was actually amazing opportunity to buy in through that period as well.
Yeah, no, definitely. Well, we'll close it out there for today. Billy, appreciate you being on here, mates. And 5 stars on Spotify and Apple. If you guys are getting value out of this, check out all of the social media channels. Steve's newsletter goes out every week that you can subscribe to. And if you do want to have a chat with any of the financial advisors in the business, you can jump on the website and take your pick, and you can book in for a free 15-minute call. Billy, really appreciate your time, mate, and look forward to seeing you on the next one.
Thank you, Josh.
Cheers.